Welcome to this Bennett Explains finance video. This week, what's going wrong for hedge funds? Now, it is going wrong. Industry insiders are saying things like, frankly, I'm blown away by the lack of talent, the fee model is broken, and the whole sector is just unbelievable. So what's going on? Well, first of all, a quick reminder, what are hedge funds? They are not defined by law, which makes it a bit tricky to say this is a hedge fund, but essentially they share certain features. They can be open or closed-ended, they can be available to the public or not available to the investing public. On top of that, they are funds characterised by the strategies they adopt. They tend to follow strategies that conventional funds either won't or can't, hunting for opportunities to make money, hopefully where their competitors haven't spotted the opportunity yet. So they use strategies, which I cover in other videos, labelled grandly as long-short, relative value, macro, event-driven, and they pursue them using risk. So they'll tend to be able to bet on prices falling as well as rising, it's called short selling, and they use derivatives on top to basically means they can pile a lot of potential money at a small opportunity, pennies in front of a steamroller, if you will. Now, it's the mystique around hedge funds that's worked in their favour so far, but is working against them now. So here are 6 reasons why hedge funds will stay in the news this year, possibly for the wrong reasons. Performance is the big one. So far, 2016 has been the worst year since 2009 for hedge funds, according to Bloomberg. Outflows have totaled around $15 billion US. Average performance is a drop of 0.7%, and that's coming from an organisation that only looks at survivors, let alone the funds that failed and didn't even make it into the stats. And some of the biggest names in the business are down 15% or more just in 2016, clearly underperforming even boring old indices like the FTSE 100 or the S&P 500. Second criticism is fees. So not only are hedge funds underperforming, they're charging handsomely for doing so. Most funds have a structure that charges an annual management fee and a performance fee. Typically, the top one could be 1 to 2% of assets under management, and that one could be anything but, let's say, 10 to 20% of performance over a benchmark that they select. So, just a quick look at what that means. It basically means they're in a kind of win-win as hedge fund managers, because let's say a fund takes a 2% annual management fee and 20% of the performance over a benchmark that it's chosen, and its current NAV is 100 million. All right? If it manages to increase that NAV by 20 million and the benchmark it's looking at rises 10%, how much richer will those managers be potentially? Well, a healthy 2.4 million, that's assets under management, 2% of the new net asset value, plus a performance fee of 20% of the bit they've achieved above the benchmark, adds another 2 million. Nice work if you can get it. But they win, just less grandly if you like, even if the NAV doesn't move, let's say stays 100 million, and the benchmark rises 10%, because then they can still justify taking out the annual fee, that's based on assets under management, whether they rise or fall. They just may not get a performance fee. And if, just to give you a third scenario, the NAV actually falls, the benchmark rises 20%, they'll still take out the AUM, because that's how AUM to work. The performance fee is debatable. Some of the less scrupulous funds will take a performance fee, others won't. Third, secrecy. Now, people don't mind a bit of secrecy if they can see hedge funds beating the market and making them lots of money, but they hate it when they can't. And whilst hedge funds used to say, well, we can't tell everyone what we're doing because everyone will copy us, investors are kind of getting tired of that line. They want to know what's going on in the black box, if you want to call it that. Fourth one is competition, the law of diminishing returns. Hedge funds have grown massively. The sector's rapidly expanded, and I'm afraid, like any sector that does that, it gets harder and harder and harder for new entrants to actually make a mark and find those opportunities because everyone else is doing the same thing. And that means that hedge funds are struggling to find new talent, hence the quote at the start of this video, and they're struggling for new ideas. And people are beginning to wonder, how can they stay ahead of the field when they're so large and such a big part of the market now? Tough markets. This is important. Hedge funds are just not reading things correctly. Central bank action at the moment is really hard to predict, and hedge funds are no better at it than the rest of us. China's slowdown is hard to measure and gauge, and a lot of funds got caught out when China bounced fairly recently. The dollar is foxing a lot more funds, and markets have just got more volatile. Now, if hedge funds were in there saying, this is perfect for us, volatile, difficult to read markets, we're the experts, we're the rocket scientists, we're making you more money, people would say, great, but they're not. All the evidence suggests that hedge funds are reading the market as badly as everyone else and just chucking more money at trying to make money from the situation. Then there's risk. Short selling is a tool available to hedge funds. It's very, very risky if you get it wrong, and the use of derivatives can magnify losses as well as profits. And the problem they've got is that in volatile markets, the price of insurance goes up, the price of options contracts rises. It gets harder, basically, to make money some of the traditional ways that hedge funds like to. So for all those 6 reasons, hedge funds are struggling, and I think may well continue to struggle over the course of this year. Some are better than others. Selection is vital, and trying to find out as much as you can about what's going on is vital too. Any questions, editor@killick.com. And if you want to see any other videos related to hedge funds, please do go to the website killickexplains.com, have a look under the Investing Principles tab, and you'll find a video on what makes hedge funds different.